Quote of the day. I will tell you how to become rich. Be fearful when others are greedy. Be greedy when others are fearful. Warren Buffett. Welcome, aspiring investors, to my channel. Today, we're diving deep into the exciting world of innovative investment strategies. If you're new to investing or looking to enhance your investment knowledge, you're in the right place. We understand that starting your investment journey can feel like stepping into uncharted territory, but fear not. In this segment, we'll break down some key strategies that are not only beginner-friendly but also vital for building a strong financial foundation. Investing can be a powerful tool to grow your wealth over time, and making informed decisions is the key to success. So, what are these smart investment strategies, and how can they help you achieve your financial goals? Stick around, and we'll walk you through each one step by step. But first, if you haven't already, be sure to hit that subscribe button and ring the notification bell so you won't miss any of our valuable insights on finance and investing. Alright, let's get started with our first strategy, the power of diversification. Stay tuned. Ready to supercharge your investment game? Let's go. Key point 1, diversification. Now, let's delve into our first smart investment strategy, diversification. Diversification is a fundamental principle in investment, and I'm thrilled to shed light on its significance. Here is a brief explanation of diversification and why it's so crucial. Diversification means spreading your investments across different asset classes, such as stocks, bonds, real estate, and even various industries within those classes. It's crucial because it helps reduce risk. And how does diversification reduce risk? You may ask. Well, when you diversify, you're essentially not putting all your eggs in one basket. Different assets have different risk profiles and tend to perform differently under various economic conditions. By holding a variety of investments, you can potentially minimize the impact of poor-performing assets on your overall portfolio. Here are some practical examples to illustrate the benefits of diversification. Let's consider a hypothetical scenario. Imagine you invested all your money in a single company's stock, and that company faced unexpected challenges, causing its stock price to plummet. You could face significant losses. That sounds risky indeed. Now, contrast that with a diversified portfolio that includes stocks, bonds, and real estate. If one asset class underperforms, others might perform well, helping to offset potential losses and maintain portfolio stability. So, diversification acts as a safety net for your investments. It's a strategy to help manage risk without sacrificing the potential for returns. For explaining the importance of diversification so clearly. Now, for our viewers, what are some practical tips for implementing diversification effectively? Implementing diversification involves selecting a mix of assets that align with your risk tolerance and financial goals. Start by assessing your comfort level with risk. Based on that, you can determine the allocation of assets in your portfolio. A well-diversified portfolio typically contains a mix of assets that don't all move in the same direction under various market conditions. Diversification truly seems like a smart strategy for beginners to protect their investments. There you have it, folks, diversification, our first smart investment strategy, together with some valuable insights. We hope this discussion helps you understand why diversification is a fundamental pillar of investing. In our next segment, we'll explore another essential strategy, dollar cost averaging. But for now, don't forget to subscribe if you haven't already and hit that like button to show your appreciation. Key point 2, dollar cost averaging. Further with our exploration of smart investment strategies. We've just learned about the importance of diversification, and now it's time to dive into another powerful strategy, dollar cost averaging, DCA. What is DCA and how can it benefit our viewers, especially those who are new to investing? Dollar cost averaging is an investment strategy where you consistently invest a fixed amount of money at regular intervals, regardless of the asset's price. The beauty of DCA is that it helps reduce the impact of market volatility and emotional decision-making. It allows investors to buy more shares when prices are low and fewer shares when prices are high, ultimately leading to a lower average cost per share. Here are some practical benefits of using DCA method. One of the key benefits is risk reduction. With DCA, you don't need to time the market perfectly. By consistently investing, you're less exposed to the risk of investing a lump sum at a market peak. So, it's a strategy that helps investors navigate the ups and downs of the market. It also promotes discipline. Investors following DCA tend to stick to their investment plan, which is essential for long-term success. Question here: what are some practical tips to get started? To get started with DCA, choose a regular interval for your investments, whether it's weekly, monthly, or quarterly. Determine the amount you're comfortable investing consistently. Then, set up automatic contributions to your investment account to ensure consistency. The concept is an approach that aligns well with long-term investment goals and minimizes the impact of market volatility. DCA is a valuable strategy, especially for those looking to invest steadily over time without trying to predict market movements. Stay tuned, everyone, because, in our next segment, we'll explore another smart investment strategy: the power of long-term investing. Key point 3: long-term investing. Till now, we've explored diversification and dollar cost averaging, and yet it's time to tackle a strategy that's often hailed as a game changer: long-term investing. What is the essence of long-term investing and why it's considered a smart strategy, especially for beginners? Well, long-term investing is a strategy where investors buy and hold investments for an extended period, often years or even decades. The primary idea behind this strategy is to harness the power of compounding. Compounding occurs when your investment returns generate additional earnings, and those earnings, in turn, generate even more earnings. Over time, this can lead to significant wealth accumulation. So what could be some practical benefits of long-term investing for our viewers, especially those who are just beginning their investment journey? The answer is, one of the key benefits of long-term investing is the potential for higher returns. While short-term market fluctuations can be unpredictable, the historical trend of the stock market has been upward. By staying invested for the long haul, investors can ride out market volatility and potentially benefit from the market's overall growth. It is about patience and letting your investments grow over time. Additionally, long-term investing can reduce the stress of trying to time the market or make frequent trading decisions. It promotes a set-it-and-forget-it mentality, which can be especially beneficial for beginners. To succeed with long-term investing, start by defining clear financial goals and an investment plan that aligns with those goals. Diversify your portfolio to spread risk, and periodically review and rebalance your investments to stay on track. The purpose is a strategy that not only simplifies investing but also fosters discipline and consistency. Discipline is a crucial aspect of long-term investing. Staying focused on your goals and avoiding impulsive decisions is vital. Our journey into smart investment strategies continues. In the next segment, we'll explore how understanding your risk tolerance and optimizing asset allocation can elevate your investment game. Key point 4: risk tolerance and asset allocation. So far, we've covered diversification, dollar cost averaging, and the power of long-term investing. Now, it's time to discuss another critical aspect: understanding your risk tolerance and optimizing asset allocation. To start, it is essential to understand risk tolerance and why it plays a pivotal role in successful investing. Risk tolerance refers to an investor's ability to withstand fluctuations in the value of their investments without experiencing significant stress or anxiety. It's crucial because it influences your investment choices and overall strategy. Determining your risk tolerance involves considering your financial goals, time horizon, and how comfortable you are with the possibility of losing some of your investment. Question: how can understanding and aligning your risk tolerance with asset allocation benefit the viewer here? Answer: asset allocation is the process of distributing your investments among different asset classes, such as stocks, bonds, and cash equivalents, based on your risk tolerance and financial objectives. It's a crucial aspect of investment planning because it helps manage risk while striving to achieve your goals. It's about finding the right balance between risk and reward. A well-thought-out asset allocation can help you build a diversified portfolio that suits your individual risk profile. It allows you to potentially capture growth while mitigating potential losses. What practical steps can someone take to assess and optimize his or her asset allocation? To assess your risk tolerance, consider factors like your financial goals, time horizon, and how comfortable you are with market fluctuations. Online risk tolerance questionnaires can also be helpful. Once you've assessed your risk tolerance, work with a financial advisor or use tools to determine the optimal asset allocation for your goals. Customizing your asset allocation ensures that your investments align with your objectives and comfort level with risk. Our journey into smart investment strategies is far from over. In our next segment, we'll explore the world of research and education, helping you stay informed and make informed investment decisions. Key point 5: Research and education. To summarize it, till yet we've covered diversification, dollar cost averaging, long-term investing, understanding risk tolerance, and optimizing asset allocation. Now, let's delve into the critical role of research and education in the world of investing. Research and education are the cornerstones of informed decision-making in investing. They empower investors with knowledge, enabling them to make well-informed choices and navigate the complexities of the financial markets. Without adequate research and education, investors may make impulsive decisions or fall victim to misinformation, leading to costly mistakes. One of the primary benefits is increased confidence in your investment decisions. When you understand the fundamentals of your investments and the broader market, you're better equipped to stay the course during market volatility. Additionally, research and education can open doors to a broader range of investment opportunities. The more you know, the more diversified and well-rounded your investment portfolio can become. Tips: to invest in research and education, start by reading books and articles, watching informative videos like ours, and following reputable financial news sources. Consider taking online courses or attending seminars related to investing and finance. It's also wise to explore resources provided by reputable financial institutions. The world of finance and investing is dynamic, and ongoing education is key to staying ahead. As we wrap up this segment, remember that knowledge is power, especially in the world of finance. In our next and final segment, we'll explore some practical tips and inspiration to boost your confidence as you embark on your investment journey. If you're finding this information helpful, don't forget to subscribe and hit that like button to show your support. Conclusion: we've covered a wealth of knowledge today, from diversification to dollar cost averaging, long-term investing, understanding risk tolerance, and the importance of research and education. Before we wrap up, to our viewers, I want to emphasize that investing is a journey, not a destination. It's normal to have questions, doubts, and concerns. But remember that knowledge and discipline are your allies. Take the time to understand your risk tolerance, invest for the long term, diversify your portfolio, and keep learning. Over time, your confidence and financial well-being will grow. Furthermore, I want to express my deepest gratitude for joining us today till the end. Your commitment to improving your financial future through education and smart strategies is commendable. If you found this video helpful, don't forget to hit that like button, subscribe to our channel, and share this valuable knowledge with others who may benefit from it. As we conclude, I want to leave you with one final thought. Investing is a powerful tool that can help you achieve your financial dreams. With the right knowledge and a well-thought-out strategy, your journey towards financial success can begin today. Thank you once again for joining us on this enlightening adventure. We'll be back with more insightful content to support your financial growth. Until then, remember that the world of finance is within your reach. Stay curious, stay informed, and always invest in yourself. Happy investing!